Welcome to the War Hunt Quarterly Investment Update for the quarter ending 30 June 2020. My name is Sam Hunt, and today I will be joined by the newest member of the War Hunt team, Dr. Steve Garr. Steve is the principal of Principia Investment Consultants and is an independent member of the War Hunt Investment Committee. Steve's role is really to provide further academic rigour and support and insight to the War Hunt Investment Committee. Well, Steve, it's certainly been a pretty wild ride in markets this year. If we look at what happened in March with sort of COVID coming onto the scene, what have we seen this quarter that might sort of differentiate it from last quarter? And obviously this quarter is also the end of the financial year.
Yeah, thanks, Sam, and welcome to you and welcome to everyone watching. It's absolutely been a wild ride in markets, but this quarter, in fact, has been the best quarter in decades. And I'm going to put up a chart in a moment to just show you how the local market has gone both over the quarter, but also over the whole year. So here's a chart of the ASX 200 over the last 12 months. And we've highlighted the last quarter with that shading to the right of the chart. Now, in the last quarter, the market's up 16.5%. Now, that's the best quarter since September 2009. And before that, the best quarter was way back in September 1987. But putting this in context, you can see that over the whole year, the ASX 200 is down by 7.7%, and that's its worst 12 months since the global financial crisis. Now, I haven't put the US stock market chart up, the S&P 500. It looks very similar, but there's one big difference. Over there, the quarter was up by 20%. That's its best quarter since 1998. But more importantly, it basically completely wiped out the losses from the first quarter. So the S&P 500 has basically regained all the ground it lost earlier. And even over the last 12 months, remarkably, that index is up by 7.5%, which is mainly due to the very strong last quarter of 2019. But year to date, the US market is pretty flat.
Well, that certainly is good news after what we experienced last quarter to the end of March. Just wondering if you could probably dig a little bit deeper and tell us about the performance of the different markets and the different asset classes.
Yeah, absolutely, Sam. Let me put up another chart now that'll show both how cash and bonds went, and then how equities went, and in the Australian market and the developed market, and how the emerging markets went, and we'll also have a look at how real estate went over this period. So let's start with cash on the left-hand side of this chart, and the cash return, pretty dismal, as you can see there. It's 0.06%. That corresponds to about 0.25% on an annualized basis, which is, of course, the official cash rate in Australia. Next, we've got Australian bonds, which has got a negative performance, a slight negative performance there of minus 1.3%. That might surprise some people that bonds can have a negative return, but in very short periods of time, bonds can have negative and positive periods, obviously. And don't be surprised by that. Bonds do have volatility around them, just not as much as equities. And it's also not unusual that when the stock market has a strong run, the bond market doesn't do as well. Nonetheless, when I look at global bonds, the next column there, they had a very strong return of 2.3%. And in fact, over the whole year, the Australian bond market and the global bond market returned very similar, about 5%. So that's compared to a cash rate in Australia of 0.25%. So not a bad return from bonds there over the year. Next in line, I've got the Australian market. We talked about that, very strong, but the best asset class was Australian listed real estate trusts, or REITs. And that's also not so much of a surprise, because in the last quarter, it was those Australian REITs that were the worst performing asset class. They got hit really hard. So this is a bounce back. Then when we come to look at the developed markets, the international markets, the return there for an unhedged investor is 5.9%, and for a hedged investor, it's 17.8%. Next, we look at global real estate, and you'll see that's a small negative too, which is out of sync with what's happening in Australia. That's probably just got to do within Australia, our our cities and buildings were locked down very early on when COVID started, where in other markets around the world, that's taken longer for the cities to be locked down, and therefore the real estate market has taken longer to realise what's going on. And you see that reflected in the negative return of global REITs in this quarter. And then finally, we finish with the emerging markets. That had a pretty good return too, of 5%.
So Steve, sort of looking through those quarterly returns, I've noticed there's a big difference in the return of developed markets. What can you tell us about that?
Yeah, okay, Sam. Look, I'll put up a little chart to show you the behaviour of the Aussie dollar against the US dollar over the last quarter, the last year. But basically, the difference in hedging has all got to do with that movement in the Aussie dollar. So let's have a look at that now. And you can see in the chart we've put up here, it shows the Aussie US dollar over the last year. And once again, we've highlighted over the last quarter. And you can see that while markets fell in the first quarter, so did the Aussie dollar. And when markets rose in the second quarter, the Aussie dollar rose as well. And that really affects this difference in performance between hedged and unhedged investors. You know, if you look over the long run, it doesn't really make any difference whether you're hedged or unhedged. You get much the same volatility, you get much the same return. So the best thing to do with hedging is to have a 50-50 strategy. Remember, currency markets are highly volatile, impossible to pick where the dollar is going to be at any time. And the chart we're looking at is just an example of how volatile that Aussie dollar is.
Now, before we sort of review the performance of the various premiums that we at War Hunt focus on for our clients, I think it's probably worthwhile just touching on again our investment philosophy. There's been decades of economic research and empirical studies that have shown that there are premiums that exist in both the equity and the fixed interest markets. Small companies, as defined by market capitalizations, tend to do better than large companies over time. And value or lower relative price companies tend to do better than growth companies or higher relative price companies over time as well. In the fixed interest markets, credit and term are the drivers of return. So those are the factors that we build into clients' portfolios. And so, Steve, with those premiums in mind, how did the markets play out over the past quarter?
Thanks, Sam. Let me put up another chart now that will actually show both in the Australian market and the developed markets, how did small caps go against the broad market and how did value stocks go against growth stocks? So let's have a look at that now. So in the chart we've got up on screen now, the bars going up represent returns of different parts of the market in the last quarter, while the bars going down are the same parts of the market, but looking at the performance over the whole year. Starting on the right-hand side, we're looking at how did Australian small companies go, and you can see that they're the best performing part of the market in the last quarter. And in fact, even over the last year, they've done better than the broad market. So still negative, but not as negative as the broad market. So that broad market is represented by that second group of columns there. So in the first quarter, small companies have done better than the broad market as represented by the ASX 300. Moving further to the right, that third group of bars, that's how value went. And the last group of bars is how growth went. And what you can see is in the quarter, value's the winner out of that. There's a positive value premium in the quarter. When we look over the whole year, though, that's not the case. In fact, value has underperformed growth companies there. Growth has etched out a very small positive result over the whole year. The next chart we look at is the international market. And in this case, once again, starting on the left-hand side, global small companies outperformed their broad market cousins there. So the global small market did better than the broad market in developed markets. Over the whole year, though, that's not the case. Small has underperformed the broad market. You can see the return of the broad market there is positive. And that positive return over the whole year is really due to one main part of the market, and that is US growth companies. And if you look at the far right there, you'll see how growth companies have done so much better than value companies, both over the quarter but also over the whole year. And that, of course, is pretty much being driven by those group of companies that they refer to as the FANGs: Facebook, Apple, Amazon, Netflix, Google. They've been having a very strong run, and that's reflected in the negative value premium you see in this chart.
Now, Steve, I know you don't like making predictions, but I might get you to bring out your crystal ball now. What do you think's in store for the economy in the near term? And probably importantly, what's in store for Afterpay?
If I had a crystal ball, I wish I had have owned Afterpay shares. What's in store for Afterpay? Very hard to know. Meteoric rise often follows by a fall, but we don't know that, Sam. As far as the economy goes, of course, we don't know really what's in store for that too. We do know it's going to be a continuing uncertain time. And to be honest, the economy is not going to sort of get back on its feet until people feel comfortable going about their day-to-day business again. And we don't know how long it'll be. Now, that sounds really dire, but I think our viewers should, of course, keep in mind that the economy and the stock market are two different things, and they're not necessarily related. So the economy is looking at what's happening right now, but the stock market is looking at pricing in expectations in the next 2, 3, 5, even 10 years' time. And that's why people often go, what's going on? Why has the stock market recovered? We saw in the US market pretty much a full recovery to where it was before COVID hit. And how can that happen when that economy is in such dire straits, or globally? And it's just got to do with the fact that the stock market and the economy are two different things. So, our viewers shouldn't get concerned that because the economic news is dire, that it also means the stock market returns will be dire. Look, Sam, we know it's impossible to time markets, but I think the last couple of months has told us the importance of being disciplined in our investments and being diversified across asset classes. And, we know that people can reach their financial goals by staying disciplined, staying diversified, and staying with a trusted financial advisor like War Hunt.
Thank you, Steve. Yeah, look, I think in closing, it certainly has been unprecedented times, and they may continue. But we've seen that both domestically and in the global markets. However, at War Hunt, when we construct our clients' portfolios, it's with the knowledge that there can be sort of huge amounts of volatility in the short term. So we don't try and predict a COVID or a stock market crash, such as we saw with the global financial crisis, but we do anticipate at some point in time that will happen through the investment cycle, and that is built into the portfolios that we construct. And the portfolios that you're invested in as clients are really based on your long-term goals and objectives, and the asset allocation is weighted according to those goals and objectives. Thank you for joining today's presentation. I hope you found the information useful. As always, please do not hesitate to contact us and discuss this or any other matter further. So thank you for your attendance. Stay safe and stay sanitized. Thank you.